Ladies and gentlemen, good day and welcome to the Q1 FY25 earnings conference call of Hindware Home Innovation Ltd, hosted by Nuvama Wealth Management. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikhil Shetty from Nuvama Wealth Management. Thank you, and over to you, Mr. Shetty.
Thank you, Michelle. Good afternoon and welcome everyone. On behalf of Nuvama Wealth Management, we invite you to Hindware Home Innovation Ltd Q1 FY25 earnings conference call. From the management side, we have Mr. Sudhanshu Pokhriyal, CEO of Bath Business, Mr. Rajesh Pajnu, CEO of Pipe Business, Mr. Sandeep Sikka, the Group CFO, and Mr. Naveen Malik, CEO and CFO of Hindware Home Innovation Ltd. Kindly note that some of the remarks or observations made during the today's call might be forward-looking, such as financial projections or statements regarding the company's plans, objective, expectation, or intentions. The company does not have any obligation to revise the forward-looking statement to reflect any future events or developments. For a comprehensive disclaimer, please refer to slide number 2 of the result presentation. With that, I would now like to hand over the call to the management for their opening remarks, post which we'll open the floor for question and answer session. Thank you, and over to you, Mr. Naveen, sir.
Thanks, Nikhil. Good evening, ladies and gentlemen. Thank you for joining Hindware Home Innovation Ltd Q1 FY25 earnings call. I hope you would have had the opportunity to go through our results presentation uploaded on stock exchange websites. I will initiate the call by taking you through the overall performance of our company in Q1. After that, Sudhanshu will share an update on the bathware and our consumer appliances business, and Rajesh will take you through the plastic pipe and fitting business. In line with prevailing macro environment, we experienced a softer start to the fiscal year. Our consolidated revenue for the quarter reached rupees 600 crores. EBITDA stood at rupees 55 crore with margin at 9.2%. Additionally, the board has approved the raising of funds through issuance and allotment of equity shares of the company of face value rupees 2 each for an aggregate amount not exceeding rupees 205 crore on right issue basis, subject to receipt of statutory and regulatory approvals as may be applicable. Now, I would like to call Mr. Sudhanshu Pokhriyal to take you through the bathware business. Over to you, Sudhanshu.
Thank you, Naveen. Good evening and welcome everyone. Despite challenging market conditions marked by elections and overall slowdown in inflation, in Q1 FY25, our bathware division demonstrated resilience, generating revenue of about 326 crores with an EBITDA of 42 crores. We improved net working capital days from 105 Q4 24 to 101 in Q1 FY25. We are confident in maintaining market share through innovative product launches, building the Hindware brand, expanding distribution, strengthening our premium brand KO. Our influencer programs and marketing campaigns are driving growth and bringing large piece production in-house aligns with our strategic objectives. So we are on track on that. Early market inputs suggest secondary sales have seen a noticeable uptick since late June, and we anticipate further momentum building up through the festive season. Our consumer appliances business delivered rupees 111 crores in revenue with an EBITDA of 3 crores and a 2.7% EBITDA margin, reflecting the positive impact of cost optimization and exiting our loss-making retail furniture business. Building upon the success of our cost optimization and business streamlining initiatives, we have deepened synergies between our bathware and consumer appliances business. This collaboration has resulted in improvements in efficiency and cost. Early wins in warehousing, logistics, marketing, and particularly institutional sales channels are promising. While the full impact of our back-end integration will be realized in the coming quarters, we are also streamlining our sales force to optimize efforts and expect extremely positive results. With that, I would like to call Mr. Rajesh Pajnu to take you through pipes and fitting business. Over to you, Rajesh.
Thank you, Sudhanshu. Good evening, everyone, and thank you for joining us. Rooflow, the leading brand for plastic pipes and fittings in its segment, reported sales of 163 crores in Q1 FY25, marking a 5% year-on-year increase. Our EBITDA for the quarter stood at 11 crores with a margin of 6.7%. We delivered strong volume growth of 24% year-on-year, with CPVC contributing 33% to the revenue. We have expanded our product portfolio with the successful launch of foam core products for underground drainage systems. Additionally, we are set to introduce high-value offerings such as double-wall corrugated pipes and fire sprinkler systems by this year. These new products align with our strategy of providing comprehensive plumbing solutions that meet specific customer needs. Despite challenging market conditions, we remain focused on market expansion, price realization to boost volume growth, and enhancing brand awareness. Our differentiated product offerings, strong distribution network, and operational excellence position us for continued success. The construction of our Roorkee facility is progressing as planned, with commercial operations expected to commence by the end of FY25. That concludes the opening remark, and I would like to ask the moderator to open the floor for the questions and answer session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Udit Gajiwala from Yes Securities. Please go ahead.
Yeah. Hi, sir. Thank you for taking my question. So firstly, if you could highlight what kind of a growth should we expect for sanitary ware faucet business, and was the margin reduction solely because of the lower top line, or do you see something else?
Yeah. So, first of all, to answer your second question, yes, the margin reduction is solely a loss of gross margin because of lower revenue, which we recorded in the quarter one. What I would like to reiterate here is that in quarter four, in end of March, we executed our strategy around combining our sanitary ware and faucet teams. If you would recall, about 4 years ago, we had actually created a sales vertical with dedicated manpower for establishing our faucet business, because we believe that we had to make a big dent in the faucet business, and we have been very successfully growing our faucet business ahead of the market for the last 4 years. So we have actually combined our faucet business and our sanitary business from the beginning of this Q1. That required a restructuring and retrenchment of a certain number of people from our organization as well. So that, added with elections along with the general slower mood in the market, has resulted in a lower growth in Q1. The market, overall sentiment in the market has not changed substantially, to answer your first question. It is similar to what it was earlier, but yes, we have seen secondaries starting to improve by the last 2 weeks of June. We believe the markets will kind of come back in half two. We are optimistic about that, and market would come back to the average growth, which it was basically showing, let's say, pre-COVID, between 8 to 10%. So that's what we believe, but that's something in the half two of the year.
Right, sir. But follow up to the answer, like you had mentioned that you will continue to outperform industry growth by 1.5%. So in H2, if you expect the industry to grow at 8 to 10, so it signifies that us to grow at 10 to 12, but full year will kind of be flattish 4 to 5% growth. Is that the peak that you are estimating? And will the major growth come in FY26, given that we are seeing some spur in demand for tiles segment already?
Yes. So we maintain our guidance around 1.5 to 2 times of the market. We've always maintained that for a long-term basis. So it's very difficult to give a guidance around beating the market by 1.25, 1.5 times on a month-on-month or on a quarter-on-quarter basis. We believe we have done that for the last 4 years, and going by that logic, I think for the year we would still be doing that. Now, if half two will grow at 8% and half one is muted, of course, the overall market growth rate would be in mid single digits or even lower for that matter. So, and we believe that we will still beat that number for the year.
Understood. Got it. And sir, second question comes on the debt on the balance sheet. As to first is the use of the rights issue that you all are doing for 200 crores, and are there any further plans for cleaning up the balance sheet?
So we are working on various options, but right now we can't confirm unless anything is approved by the board. So we keep evaluating various options, but once confirmed by the board, we'll definitely intimate to the exchanges.
So, sir, if you can just let us know that the 200 crore rights issue that you are doing, that is for what purpose?
So basically, primarily to have first a level of liquidity, better liquidity, and also to pay off the debt substantially. We'll come with a more definitive document, which is the rights issue document in the due course, which will be circulated to all the shareholders.
Understood, sir. And so lastly, on plastic pipes volume growth, I mean, what kind of a growth should we expect, and do we see any capacity constraint for this year, or will continue to grow?
Yeah. We will definitely give the guidelines which we have given earlier. That is, we will be continuing a growth of, though we have grown by 24% year on year, but definitely this complete year we will be growing by around 16 to 18% in volumes. Value we can talk here because prices, as you know, the raw material prices are fluctuating a lot, and they have come down again in the last month. But definitely there will be a volume growth of 16 to 18%. And as far as capacity is concerned, as of today, we are equipped to cover this growth.
Got it, sir. And sir, on the resin front, what kind of view do you have? I mean, do we see the prices bottoming out, and could we see some element of inventory loss in Q2?
Precisely inventory loss. Talking about inventory loss, we didn't had an inventory loss because as of now almost all the people, whatever has been happening in the market last 2 years, all the people have used out their inventories. But we had a good time after 1 year of sluggish listing in May and June. We had an upward trend, and the prices went up by around 15 rupees a kg. And we saw a good June contributing to the business. But all of a sudden, this month again, the prices have come down by 11 rupees. So the guidelines is like it is still there a little, trend which looks like downward trend, and then it may bottom out after 2 months.
Got it, sir. I have further questions. I'll fall back in the queue.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. We'll take the next question from the line of Naisar Parekh from Native Capital. Please go ahead.
Yeah, hi. Thanks for the question. First is on, on your bathware business. When we compare to some of your peers, the decline in this quarter is obviously much sharper, and even for our margins. So can you just comment a bit on that? Are we losing market share? Why is the performance a bit inferior to some of your peers?
Yeah, so like I mentioned as an answer to the previous question, maybe you're responding to the growth number may have come from the other listed entity. We have data from other listed players as well, or unlisted players as well, and and based on market intelligence. And we believe that we have actually fallen in a very similar zone. Like I also mentioned, we have impacted nearly 25% of our sales force in this quarter based on our decision to consolidate and synergize between our sanitary ware and faucet verticals, which we intended to do for some time, because most of the other companies basically operate with one single sales force. In fact, we've got a feedback from the market that perhaps we have an opportunity to optimize our manpower cost as well. So as a result of that, we've had a dual impact in the quarter one of this year. And that's why perhaps there is a bit of a difference between the results of the listed entity versus us. I can assure you from my side that in comparison to the other unlisted entities, our results are very much in line. And in fact, I would say much better, considering the fact that we've impacted 25% of our sales force. I hope that clarifies.
Could you quantify the impact of the employee costs in the quarter?
No, so I can't, because when you execute, you will basically, it takes you time to get that benefit in your P&L. We believe that it is going to help us increase our margins by 100 basis points plus for on an annualized year. On an annual basis, yeah.
Second question is, on the pipe side, from the margin perspective again, I think last quarter we, Q4 obviously revenues were high, but overall the guidance was that we should see margins to improve versus the last year. So how should we look at the EBITDA margins in the pipe business? Where do you see that directionally? Our realizations seem to, like you were saying in the previous question, should bottom out. So how should we look at margins now going ahead?
Yeah. The guidelines which we had given was on an yearly basis that we will have a double-digit EBITDA growth, which we actually achieved last year.
Your voice was not very clear.
Hello. Am I audible?
Yes. Now better, please. Thank you.
Yeah. So the guidelines which we had given for a double-digit growth was for an annualized basis, which we did achieve. In Q1, what happens is the volume of business is very, very less in Q1 in this industry. One. Second, the prices are so low that it's becoming very difficult. You are only processing and doing the volumes. It's very difficult. It is a difficult situation because we can understand that we have not been able to achieve any growth on the EBITDA side as far as year-on-year it is concerned. We have not degrown, but we are the same. It's at 6.7%. But as far as the guidance for the whole year is there, because Q3 and Q4 for this businesses are at its peak. That is how this business runs, this industry runs. And we are definitely giving a double-digit growth guidelines of EBITDA for the whole year with an annualized volume growth of 16 to 18%.
Okay, understood. And just last question, besides the 200 crore equity that you are raising, are you planning to raise any more equity through any other modes?
I've already answered that in the question number 1.
All right, okay. Thank you.
Thank you. You may please press star and 1 to ask questions. The next question is from the line of Utkarsh Nopani from BOB Capital. Please go ahead.
Yeah, hi, good evening, sir. Sir, my first question is on the balance sheet side. Like earlier, we were anticipating that we will see a release of some of our cash due to the improvement in our working capital position. But our net debt has gone up by 100 crore on a sequential basis, despite decline in our revenue by 22%. So why our debt has gone up on a quarter-on-quarter basis, and what is our capex guidance for FY25 and 26?
So I think the main reason why the debt has increased is that we couldn't, reduce the level of working capital because of the slowness in the market and some of the inventory stuck with us right now. Point number 2, we are right now undergoing a capex program wherein we are setting up a new plant in Roorkee and also some additional debottlenecking
new lines are being set up in the pipes division, and also we are working on productivity enhancement in the other plants. So we feel that other than the pipe plant in Roorkee, which is coming up, which should be there in this financial year, working at this financial year, total cost of around 170-180 crores. The normal capex should be ranging between, I think, 70-80 crores should be there.
Okay. Sir, how much total amount we are planning to spend? 170-180 crore for the Roorkee plant. Possibly we must have spent quite a lot by FY24 itself. So how much amount we are planning to spend in FY25?
Major amount is yet to be spent on the pipe plant because equipment has now started coming in. Most of the land and civil work is complete. Machineries would now start coming in. So we can say around 40% of the expense has been done and balance will be incurred in next 9 months.
Okay. So you mean to say that we are planning to spend around 170-180 crore in FY25. Will that be the right understanding? In total, Roorkee plus debottlenecking.
No, Roorkee, total will be somewhere around that range only, yes, given the fact that the land was procured last year.
Okay. And whenever our inventory position or the market situation is going to improve, how much release of the working capital we can see maybe in the coming 2-3 quarters down the line?
So we ended up, we typically the working capital increases in your first half of the year, while it actually comes down by the end of the year. We have seen an excessive slowdown in the working capital in the market, even for most of the consumer as well as the bathware business, and that's where a bit of a pressure comes on to the working capital. So we believe that we can easily kind of bring it down by about 10 to 15 days, by the end of the year. So that's something which we are looking forward to, and we are working on. We had shared that, we would be basically insourcing many of our imported, products in bathware. We've already done that. It's just that now the market is not supporting us. So whatever inventory we had to keep before that insourcing, we had to maintain, we are maintaining. So all those benefits, I talked about manpower, headcount, all that, all of them will basically start coming into our financial statements, P&L or my balance sheet. From some will come in Q2, and most of them will come in Q3, Q4. For Q3, I think most of them would come. So that's that.
So my second question is on bathware and consumer appliances segment. So in this June quarter, we have mentioned that we have done some restructuring of our sales force team. So our performance has been impacted. So are we completely done with it, and we are not likely to see any further impact going forward for the bathware operation? And for the consumer appliances, can we now safely assume that we are completely done with the product realization impact, and the segment could start generating positive revenue growth with low single-digit margin going ahead?
So what we were talking about was as an answer to the bathware business. In the bathware business, we had only one specific objective around merging our faucet business into our sanitary business in terms of the manpower, in terms of the sales force. We have done that. So no more restructuring to happen for the bathware business. There is none planned. In fact, what we have done is we are now having a lot of synergies which are shared between our bathware as well as our consumer business in terms of our back ends. So this, marketing, logistics, warehousing, it's all now getting, the synergies are coming into both consumer as well as our bathware business. So that's already happened now. In terms of our execution is done, the benefits will start coming into us in the course of the year. We will be evaluating if there are any categories where we're not making money or we're losing. So some evaluation of the categories in our consumer business is an ongoing exercise which we do. So if any other restructuring which can happen is around those lines, but for that, I think most of our restructuring has already been done, and the benefits will start coming in the second half of the year.
Okay. And in the September quarter, we are not expecting any deterioration in our bathware segment performance because of the sales force restructuring which we have done in the June quarter. Is that the correct understanding?
Yes. So you're absolutely right. That's a one-time impact. We took out, like I said, 25% of our off-roll and on-roll manpower in that time, and we believe, it had whatever impact it had to have happened in quarter one. Quarter two will basically be more reflective of the market.
Okay. Thanks a lot, sir.
Yeah.
Thank you. The next question is from the line of Amit Kumar from Determined Investments. Please go ahead.
Hello, can you hear me?
Yes, sir. Please proceed.
Yeah, thank you so much for the opportunity. So, first question is, how should we read into your appliances business? So, principally, fans and air coolers with a little bit of kitchen also. Now, in this particular quarter, the consumer durables and, specifically, air cooler, I mean, the one air cooler company, which is listed, the numbers that we have seen, very, very strong performance in terms of both top line as well as bottom line, principally on account of the, heat wave. But when I look at your consumer appliance, business, it has not really gone, anywhere. So, even in a good sort of macro environment, the business doesn't sort of seem to be, going anywhere. EBITDA losses, rather EBIT losses, segment losses are still there. What do you plan to do with this business?
So, for us, the air cooler business, so I know you're talking about one of the listed companies' results, sharing results which are where their air cooler business grew by about 70% plus. Now, that's because the large part of their total business comes from the air cooler business. Now, for us, not even 20% or even lesser of that, I mean, less than 20% of our business comes from air cooler business. And even in this quarter, for that matter. And if I'm growing, and I'm actually growing at very similar rate as the listed entity on the air cooler side, my overall growth gets impacted because a large part of my business comes from the kitchen appliances business. The kitchen appliances did not grow, and that, if you have to compare, you can compare with, again, listed entities which have reported their results. So you'll have to go category by category, and the mix of the categories will give you the numbers which we have reported. Notwithstanding that, I'm not defending the numbers. I'm saying that, yes, we are in the process, as I answered in my previous, as a part of the previous question, we are evaluating the product categories in which we are operating, and we believe we will have, some outcome coming out of that, and we will, in case we don't foresee any strategic future in some of the categories, we'll come back to the investors and, share if we are making a transition within the organization and, evacuating those categories. At this point in time, we believe that kitchen is our core business. That's where we make our margins. And currently, there are some categories which are eroding all the margins which we are earning in the kitchen part of the business. So this evaluation is currently on. If once the conclusion is done and we make appropriate decisions, take an approval from the board, I can share more details with the investors.
Understood, sir. Just one sort of, small further question. You talked about a little bit of retrenchment that you have done, on the sales force side, in this particular quarter. Were there any sort of one-off expenses, on account of that? And would it be possible for you to quantify it?
No, nothing substantial. Nothing substantial coming because of that. The only thing is that, yes, the benefits of the reduction in the manpower is not yet coming into our P&L.
All right. Understood. Thank you. That's it from my end.
Thank you. Participants who wishes to ask questions may press star and one now. The next question is from the line of Udit Gajiwala from Yes Securities. Please go ahead.
Yeah, thank you for the follow-up, sir. Sir, could you quantify what was the premium, mid, and the mass split in our sanitary ware faucet business in value terms for this quarter versus Q1 of 24?
Can you repeat the question, please?
Voice was not clear.
I couldn't get it.
For the bathware segment, can you give us the split? What was the premium, mid, and the mass category contribution?
Okay, just a second. So the premium for us, the way we define it is basically is about
53%.
No. 47.
Yeah.
47% was premium for us, while 53% was our economy range.
23.
53, 47 is premium. Yeah.
And the same number in Q1 of 24, if it's possible?
It was 52 for economy and 48 for premium.
Okay.
Sorry.
Yeah.
Sorry, it was 47 for economy, my mistake, and 53 for premium. Yeah.
Understood. And the next is a bit broader question, like from your commentary for last couple of quarters, we are hearing that you are doing a lot of corrective actions for the whole business in terms of your top line margins and also the work that you are doing on the balance sheet front. So in next 2-3 years, broadly, what kind of a top line for the whole company as are you all targeting, and with what kind of steady state EBITDA margins on a blended basis?
So historically, we had given some sort of guidances here, but those guidance have not worked in the last financial year and I think Q1. But the way we have planned ourselves, we feel on a medium to long-term range, we should continue to grow on an average 15 to 18% on sales and 20% plus on the EBITDA margin. So basically, and when I'm talking here I'm talking more of Hindware right now from that perspective, because both the companies have financial matrices. And when we see last financial year, we had a net Hindware Limited EBITDA margin at around 13.5. I think with an expansion of this by another 2% in next 2 years, 3 years is easily feasible and easily visible with the actions which are already taking, not considering the fact that there will be further opportunities for growth which we are looking at and which will make our EBITDA more healthier going forward.
So 20% is for your bathware plus the pipe business is what you're talking of, 20% EBITDA margin, both put together.
I'm talking CAGR growth, CAGR growth.
EBITDA. Okay.
But growth is not on a quarter to quarter, but that's our objective. Next 3-4 years, we should be able to demonstrate 20% on EBITDA.
Got it. And sir, any internal targets as to what kind of debt reduction could we expect, barring your, whatever extra rights issues or anything from your operations that is possible this year or no?
So I think this is 1 year wherein we are putting up the facilities. We feel that pipe business has an ample opportunity to grow, so that's one piece of investment. Secondly, as Sudhanshu said, the focus is completely to in-source material from and provide an alternate to imports. Over the last 2 years, we have worked on it. We may further work that how further in-sourcing we can do by expansion, debottlenecking of the facilities. So post the current year, I think capex plan next year, capex plan should now get marginalized, and basis which I think we have now by that time we'll have ample opportunities to have into volumes within our own balance sheets to cater to the market and not relying extensively on the external outsourcing model. This will also help us, further garner up the margins, which we had talked about. Because right now when we import from China, a lot of margins are left with the vendors in China, which we plan and intend to bring it in-house. There are various streams of growth which are there. I think as soon as the market looks a little bit positive, which we feel that I think once the festival season starts coming in, Sudhanshu has already spoken that from the second half of June we are seeing a better secondary offtake in the market, but the dealer distributors are right now stuck with the inventories. So maybe another 2-3 months we can see a positive development in the market. These are very initial responses on the secondary stuff. But as you move forward, we are ready for capturing the growth which should happen in the market now.
Right, sir. Actually, sir, the intention was asking, what is the current then outsourcing for the quarter from China?
It'll be like low single digits, like 3%. So when we started off,
this used to be
17-18%,
18%. And from the last 2 years, we are reducing this.
Got it. Okay, sir. All the best. Thank you.
Thank you. The next question is from the line of Nikhil Gada from Abacus AMC. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. I know this is sort of, you have already mentioned about how the market outlook is. Is it possible to just share how has been July in terms of growth? Have we seen growth or we continue to see degrowth in July as well?
Yeah, so secondaries have been positive in July. We've seen some positive momentum on the secondary basis, yes, across the market.
Yeah, I'm just talking from our company perspective.
So I'm also talking from the company perspective, yes.
But the financial, I think it will not be appropriate right now to share the July numbers because. But the markets on the secondary side looks good. I think that's one feedback which we can give right now.
Okay, sir. Sir, and you mentioned that we have not lost market share per se in 1Q, and you have some data as well which sort of validates that point. Is it possible to share how was the growth in 1Q for the market?
No, so there are many players in the market. What I meant when I said that is that I am aware of data for 3-4 of the top companies besides the listed entity which has actually announced their results. And this is basically based on our market intelligence, and so I meant it in that fashion, and I don't know how to share this with you, but this is how the numbers are basically stacked. Yeah.
So it's safe to say that the market degrowth was more than 10%, more than what our numbers are, right?
It will be in the similar range, yes.
Okay, got it. Secondly, sir, I understand that the market has been down and has impacted our margins. Now we were doing good margins in bathware business for the last 3-4 quarters, and now with this decline, do you think that we'll be able to achieve the EBITDA margins that we did in FY24?
So our loss in margins are basically primarily only because of the loss of gross margin which happened because of the market slowing down. If I look at all my costs on a standalone basis as a percentage of revenue, I am performing similar or better than what my projected numbers or my last year numbers were. So if it's only my fixed cost, which sits in my business, which basically is taking my margins overall down. So when I project it, if I'm by that simple straightforward logic, if I'm delivering only to adjust for inflation on my existing costs currently on the revenue side, I should deliver my EBITDA margins, which I should. Otherwise, it would be in fact better than last year in terms of percentage margin, yes.
And inherently, it's safe to assume that this business has the potential of delivering 17 to 18% EBITDA margins, right?
Yes, on a medium-term range.
We've delivered that, and we believe that we can keep on doing it, yes.
Got it, sir. So my second question is on the pipes business as well. We have seen a sort of a decline in our mix in CPVC. Also, the market conditions have been similar. Now, when we say that we are aiming for this double-digit margin of 10% or 9.5 to 10, do you think that in this remaining 9 months, the mix should be back to normalcy, as in terms of CPVC versus PVC, or is there something else like operating leverage that gives you this sort of a hope that we'll achieve this margins?
Nikhil, there are 2-3 things to it. One is what we said is like Q3 and Q4 in this, if you have seen the trends of this business and the industry, they are very big and the margins are high on those sides. Secondly, we are seeing that from the festival season onwards, as the last 4-5 months of the year, the CPVC will pick up because we are seeing that trend. The decline in the prices has stopped. Earlier, there used to be, last year it was almost around 11 to 12% volume decline in CPVC. But now it has come down to around 2 to 3%. So we are seeing some, if that remains the same, then definitely there will be a improvement in gross margin. And with the type of volumes which we'll be doing in the next 8 months, we are confident that this guideline we will achieve.
Got it, sir. And sir, just one last question, just once again on the bathware business. If you could help with the capacity utilization in sanitary ware faucets, and also if you could highlight the overall RM prices and how the outlook is over there.
Yeah. So, just a second, huh?
Yeah.
Our capacity utilization in Q1 FY25 for sanitary ware was about 86%, and for faucet was about 58.5%.
Okay.
Hello?
And on the raw material prices, how are they? As in, they are like stable, or we are seeing some fluctuation?
So we saw an increase in one of the biggest raw material for us, which is brass for the faucets, which went up to nearly 600 rupees a kg, and in fact we had some buying which we did at 588 and and so on and so forth. But we have seen cooling off of the brass prices now, which is down to 525, 530 range. So yeah, there was an escalation which happened in Q1. It also marginally impacted our margin for Q1. I'm saying marginally because it's done on a weighted average basis. Pricing is done on a weighted average basis. So based on existing brass versus whatever we bought, and it didn't really impact significantly because the prices came down later on. So my outlook for the future is that brass prices are not going to go very high. I think it's going to be it's going to be similar and stable in the range between 500 to 540, 545. That's our internal estimate at this point in time.
And we don't need to take any price hike to sort of get back our margins in this, right?
No, I don't think so. In fact, the kind of work which we have done in terms of improving our internal efficiencies, we are pretty confident of delivering the margins without taking up a price hike. Yeah.
Got it, sir. Thank you and all the best. Thanks.
Thank you. You may please press star and 1 to ask questions.
I think most of the questions which were there, we have answered.
Yes, sir. So, may I request you to give the closing remarks now? Thank you.
Yeah. So I just doing that only. So I just thank everybody who was there on the call today to make this very interactive. And if there are any further questions, always happy to make a response to them. Thank you very much.
Ladies and gentlemen, on behalf of Nuvama Wealth Management, that concludes this conference. Thank you for joining us, and you may now disconnect.